Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today, I'm joined with two of my good friends. We have our own Phil Weiss. Hey, Phil.
Hey, Kirk, good to see you. It's been a while.
It has. And we also have my very own Barb Friedberg.
Hello, everybody from sunny California.
All right. Well, I should have said our own. I don't know why I say my own. Your husband may get jealous.
Yeah, well, we'll make sure he doesn't listen to this, and then we're fine.
So he's the one that's not listening. Okay.
Yeah.
The numbers are a little off last week. We had one person who wasn't listening. All right. Well, good. We're mixing up this week. Doug was on vacation. It's the Friday before Labor Day. And everyone else is back in school except for my kids. My kids go to school next week, thankfully, so I get to enjoy it. Except for my oldest, whose first day in high school is on Labor Day itself.
Oh, how?
Why? Like, I mean,
Labor Day. They start school on Labor Day.
I mean, I love the school, but I have to say, I have this like private like joke like in my family. It's like, really, like it's like first day's orientation. It's not technically class; it's orientation, but you basically have to be there. And it's like, all right, you couldn't pick Tuesday, like, and their first day of school is basically Friday. So it's like, why don't you just bump it a day and then you can kick it out a day? Like, I'm sure there's reasons for all this, but I just have to laugh because I grew up in an era around here where you didn't go back to school till after Labor Day. It was just the thing. You didn't go to school in the summer, but now like every school around here went to school this week. And then in other states, you're going in July and August. Like, I don't get it. Like, I'm sure there's a reason, but it's just, to me, it's just foreign because you go after Labor Day. That's the whole point. But anyway, so that being said, we have a new format. We've got two of our favorite panelists here this week on the live session, in part because I couldn't choose between them. They're both great, and so I wanted to bring them both on. And anyway, so we got a lot of news, and I wanted to kick it off to Barb because a lot of news, and I'm going to forego my typical mindset rant at the beginning because we have to split the time between three people instead of two. So, Barb, what's in the news this week? What can we talk about that's really interesting and exciting?
Well, everyone's talking about interest rates. And as we all know, the Fed's job is to set interest rates and monitor unemployment and the inflation rate in order to keep our economy growing at a reasonable pace. Now, as we all know, last year inflation was really, really high. But you may not know that year over year inflation growth is only 2.2% now. And we'll talk about why that doesn't feel great, even though it is literally very good. And then we want to think about the Fed has plans to raise interest rates to lower interest rates next month. And we're going to bat around here on the panel whether we think 0.5%, 0.25% is a good idea or not. Keep this in context, everyone. Unemployment is up to 4.3%. Now, that's higher than it's been in a while. And remember what I said a minute ago? The Fed's job is to try and keep unemployment at a reasonable rate. It's creeping up a little, and as it creeps up, we also tiptoe into the potential of possibly a recession. So I think this is enough to get us started, and then hopefully later on we can delve into another favorite topic, AI. So what do you think, Phil?
I know we expect the Fed to raise rates in September. Some people think there's going to be further rates hikes coming. In some ways, that makes sense. One of the things that I look at is when we're investing, we talk about not just putting your money into the bond market because you can't keep pace with inflation. And right now, if I look at treasuries, even though rates have come down, when your treasuries are still at around 4%, that's ahead of inflation. Barb just said it was 2.2. So that would imply that there could be other rate hikes coming. I mean, rate
Cuts.
decreases
I know we're all
coming.
used to hikes. We're all screwing up here.
Yeah.
I
you
know
guys are
we
gonna
have
get
to
me, too.
shift our perspective.
Yes, we do.
Rates are going down.
Maybe.
And let me interrupt for a second, because we're talking about bonds, and I want to make sure all of you out there understand that bonds are a loan to a government or an entity or a corporation, and in return you get interest payments. And when interest rates go down, the principal value of your bond, your existing bonds or your new bonds, will go up.
Yes. The only kind of the fly in the ointment, though, for too many rate decreases is the idea that the economy is still growing, right? We got GDP is in the 2 to 3% range, maybe a little bit higher. And we don't want to overheat the economy, because then that would feed inflation again. So the Fed is trying to navigate here and do what they call a soft landing. This is a rate hike that's not as
Rate drop.
it's not driven by recession yet. It's not driven by what's going on in the economy as much as normal. It's so that it should have less impact in terms of what it does than it might otherwise. But it wouldn't be shocking if they did it again. That's what most people expect, but usually what most people expect isn't what happens.
Yeah, it's interesting to take on that tilt there, because I usually talk about a mindset shift, and here's my mindset thing for today. Now, the market is, we talk about this a lot, but the market is a prediction engine about 6 months ahead. So the market is pricing in today what's going to happen 6 months from now. Now, the problem is if you expect rates to stay the same for the next 6 months, then the prices are going to reflect what that is, if that's what the market expects. Now, if the market expects rates to drop 1% in the next 6 months, the pricing is going to be based on it dropping 1% in the next 6 months. Here's the problem, is that when the market is wrong, it needs to reprice its expectations. So I think somebody said the market is pricing in like 6 or 7 rate drops over the next year. That's how it's pricing it in. Whether it's true or not, it doesn't matter. What matters is this is what the market thinks as a whole. Now, we talked about in the show last year how wrong the market was. They think they were predicting somewhere between 7 and in some cases 12 rate drops over the next 12 months. That's ridiculous. You'd have to have a massive recession for that to happen. Of course, people were predicting a recession right around March to May, and it didn't happen, or did happen and they didn't admit it, whatever. But it didn't happen. So the point being is they didn't drop rates. They kept them the same. So my prediction, which I made with Doug last December, was they're not going to drop rates at all. At the most, they would drop one notch, like 125 basis point notch. That was my prediction. And it seems at this point we'll probably be correct. I didn't have to be a brain surgeon. I didn't have to be a PhD. I didn't have to go to MIT or Harvard or anything like that to know that. All I had to know was these people are crazy. That was the way I predicted. These people are crazy and I'm not. And sometimes that's the other way. Sometimes I'm the crazy one. But in this case, I knew they were crazy because there was no way that they would drop at 12 rate drops unless we had a massive recession. Like you remember back in 2000, they dropped it like 50 basis points in a clip mid-month, not even in a meeting. I remember I was in the business for like a month and I knew that was crazy. Like I wasn't in, that was like 99. I just graduated, just started. And I knew that was crazy. So if you think about practical, like how things are going to work out, I think there's 10 meetings a year that the Fed has, something like that. And then somehow they're going to do 12. Like it was ridiculous. So the point being is you have to understand what the market is thinking on one hand, and then what is actually going on. And, you have to make your own predictions. Now, if you're a follower and you like to follow what everybody else does, which is how the market typically works, right? People just kind of follow the crowd. Then just follow along and just do what they do. The problem is if you think that, I know leading up to NVIDIA earnings, I think it was yesterday, it was like the biggest it was the most widely followed earnings in I don't know, it was history or whatever. But based on the bets that were being made on Nvidia, it was like it was either going to go up or down 11%.
They had
That is
watch
how
parties.
yeah, that was the pricing mechanism. It was either going to go up 11 or down 11%. That's huge, right? A miss or a hit would go up or down that much. What that usually means is that that's wrong, right? Is that it's not going to happen that way because that's an extreme measure. And if the market expects it, it's not going to happen. So you have to understand that I think it was Howard Marks who talks about the second level thinking, right? First level thinking is, hey, NVIDIA is going to beat earnings, so I'm going to invest in NVIDIA before earnings. It's too late. You missed it because everyone else already thinks that they're going to beat earnings. And not only do they do it now because you're thinking about it tomorrow, they did it 6 months ago. So if you watch earnings, you really watch like, all right, what are people predicting in the future? And that's how the price is moving. So leading up to an earnings announcement, it's already been priced in. Now, it might be wrong, but it's priced in. So the understanding of the market is you not only have to look at what you think is going to happen, but you also have to look at what everyone else thinks is going to happen. And is that already priced in and are they wrong? So what we predicted last year was everyone was going to be wrong because they were crazy. And I think everybody I talked to was in line with our thinking. Like no one thought that 9 to 12 rate drops was going to happen withstanding a recession. And I didn't even think it would be a bad recession. I thought we'd have one. I did predict that and I was wrong there. But I didn't think it would be that bad because the economics didn't line up with it being bad. No, it could have been bad, but it didn't line up that way. Just like right now, and Barbara's going to talk about this, but the economics right now are lining up as we're kind of sliding into recessionary territory. Not there yet, but we're sliding. It's not going to be a tidal wave. It's not going to be, falling off a cliff at the moment, but it's leading in the direction of recession. So you have to look at the data and you have to see what's reasonable. So lesson for the day is understand that second level thinking is not just looking at something and saying, is it right or wrong? It's looking at a derivative of that thing and saying, is it right or wrong? And what does everybody else think? And are they right or wrong? Because if you figure out what they think, and if there's a massive tilt on one side, it makes sense to take the other side because you can actually make a lot of money being on the other side. And that's really the lesson for the day, right? If you think that when oil went down to negative $25 in COVID and the futures price, and if you think trend's going to keep going lower, all right, maybe you should get your head examined. Maybe going the other side might be a good idea, right? But that was the moment where everybody I knew was like, all right, where can we just put money into oil and gas at the moment because it's so obnoxiously mispriced? How can we take the other side of it? And so that's how you have to be thinking about things is where are people cuckoo and how can you do the other more rational thing because it's not priced in. And once it does get priced in, that's the price movement that's going to make you a lot of money. So hopefully that makes sense. But when it comes to rate drops, I don't know what I think yet because, frankly, I don't know what Powell thinks. I think he says he's going to drop it once this year. I think it'll be once this year because he pretty much said he's going to. I don't think there'll be any more. I think at this moment it seems like if I was him, right? And I always try to put myself in their shoes. What would I do? It's kind of like WWJD, like what would Jesus do? Like this, what would Kirk do? WWKD. Not saying I'm Jesus, but just saying. Anyway, my point is I put myself in their shoes. What would I do if I was Powell? Because I'm trying to think like, what's the most logical, rational thing he could do? Well, at the moment, it's not raising rates because you could say, well, what about inflation? We don't have inflationary pressures at the moment. I've actually tilted my opinion of I don't think inflation is going to come back. I think that was primarily driven by the supply chain, and that has been more or less fixed in certain sense where it's not going to be better or worse. It's going to be more the same. So I don't think we're going to get that. So I think inflation is going to probably decline at the moment, and I think we're probably trend in that direction. However, how do you lower rates when the market's doing just peachy keen? I don't know. And that's my open question to the Fed. Are they basing it on interest rates, on inflation, or are they basing it on market performance? That's a question I haven't had answered in the past because they've mostly been correlated, but now they might go in opposite directions. So what happens? I don't know. And I'm not going to make a prediction until I start to see some pathway there. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
Well, okay, I have to answer that question. Because in theory, the Fed does not make decisions based on the investment markets.
In theory.
But they make decisions based on the inflation rate, which, as we said, was 2.5% year over year. Now, to elaborate on that just a tad, year over year, well, last year inflation was up so high, and it hasn't gone back down to where it was 2 years ago. So that's why it hurts so much, even though it's only 2%. But the other component going into the decision of the Fed for making an interest rate decision is unemployment. And the unemployment rate, although not historically high, is creeping up. It is 4.3% now. So clearly, I don't think there's any doubt that the Fed will drop interest rates. Now,
here's a question for you, Barb.
Yeah.
Remember back in the day when 5% unemployment was a good number? I think when Clinton was in office, it was 5 and everyone was cheering. It's like, wow, only 5. Now it was down to like 2 or 3. Like, I think we're in a different paradigm. Like, how do you see that? Is that the new norm? Is that the new number we should be shooting for?
We will call this the recency bias, which is a behavioral finance term, which means most of us just look at the most recent period and make our decisions and our analyses based on that. And so that's how I explain it. You know, back in the day, I mean, interest rates at the level they are now, the Fed rate is now 5.3%, which historically is not so high. You know, it really is not so high. I don't have the data in front of me to verify what the 100-year historical Fed funds rate is, but I sure as heck know it's not like 0, 1, or 2%. So recently, though, is what we're dealing with.
Can I add one?
Yes, go on.
The other thing that we have to think about with the inflation rate, and I don't know what the number is, but it's the participation rate. And that's something that has a lot of impact on where we see inflation. When there's more jobs available, people that have been sitting on the sidelines start looking for jobs, and then they're counted as being unemployed until they find them. So that also impacts it. And so it doesn't always make for apples to apples comparisons. When you say, Kirk, that the rate was 5% was thought to be good, 4.3% now is going up. Right? We don't know. I don't know what the relative participation rate was at those 2 points in time, and that is a factor as well.
Let's talk about the participation rate, because I've heard that mentioned by a few other people recently, where like Raoul Paul talks about his macro framework, which I thought was pretty interesting. And he talks a lot about the labor participation rate. So I don't know if we want to get into that for people without putting them to sleep, but might be a good very brief topic.
Well, I think what that's pointing out is you have to take all data with a grain of salt, because also the inflation rate is measured with certain components in, certain components out. The CPI includes food and housing, other inflation rates don't. And for example, Europe calculates the inflation rate differently. So we use the numbers we have. They're not perfect. I mean, that's how I'd like to leave it. And this is basically what the Fed is going on. I think, and Jeremy Grantham thinks, and he is an esteemed professor of finance at Wharton Penn.
Jeremy Siegel.
You're talking about Jeremy Siegel, not Jeremy Grantham.
Siegel.
Jeremy Grantham's GMO.
Yes, I am. And thank you so much.
I don't want him calling the show, Barb, and yelling at me. What are you talking about, me?
I know it's next door to Kirk.
No, Jeremy Siegel. And yes, please pardon me, and thank goodness I am not running for election, because I make these type of slip-ups more times than I would personally like to admit. And that's why I have to hang out with Phil and Kirk to make sure they correct me.
We should put you on the ballot, Barb. You might make other people look better.
That is definitely true. I would definitely make everyone look better if I were on the ballot. But anyhow, so Jeremy Siegel is leaning towards, he thinks the Fed should definitely go with a higher cut. So he was saying 5.5% at a minimum, because he thinks because of the expanding unemployment rate, that will help stave off the potential for a rate cut.
Here's a question.
That will stave off the potential for a recession.
Yeah, I mean, here's the open question I have, because Wall Street's been beating on Powell for the last year. Oh my God, you got to lower rates, it's crazy, and yet we're fine. We don't have a recession. Nothing has gone wrong. I mean, I don't think highly of the Fed, as you all know, but I do think that they've handled this reasonably well, in the sense that they're fighting off Wall Street. Wall Street, everyone's been yelling and screaming at the Fed, lower rates, lower rates. Oh my God, the sky's going to fall, Chicken Little. And yet the market's up bigly, as Trump would say. You know, we've had a great year, in the sense that all he's done is just done nothing, which I think was the right move, right, based on the data. But what's interesting is when you see these people come out, oh, they should do this. I don't trust them, because what they want is they want a rip-roaring bull market so they can make lots of money and then get out and then wait till it crashes. Like, so as much as I, despise the Fed and all the stuff they do, I think they've handled it reasonably well. And it's like giving your enemy a compliment, but I have to do it. I got to be honest. I think they've managed Wall Street very well. So I don't know. It's an open question. Like, does it make sense to lower it that much? I don't know. Maybe the Fed's behind. That could be true. We don't know yet.
Look, we thought they were, and they probably were behind as far as when they started to raise rates, right? Because we stayed at zero for so long.
Yeah.
Right. And that, I mean, beyond just the supply chain, that was probably the other thing that contributed to some of the inflation that we have. But meanwhile, if we look at where we are, I know I like to read Ed Jordani as a strategist, and he's definitely in the camp that they're going to raise lower rates in September, and that's it. That's going to be it for the year. But he has said that, as have others, that what's amazing is, and this doesn't usually happen, it looks like we're going to at least have a soft landing. Right? It's not like the actions that they've taken at this point have pushed us into a recession. So, as you say, it seems like they have done a good job.
Yeah, I mean, think about it. And that's a great point, Phil. And I want to kind of like revise history a little bit here. So if you look back in 2000 and was it 22 when they raised rates? If you look back prior to that, everyone was like, "Oh my God, they're going to raise rates." Everyone knew, like there was no secret. Yet the market didn't price it in. And then January 1st, all of a sudden they decided to price it in, and then subsequently, after the market crashing because they raised rates and people were somehow not prepared, I don't know why, but they weren't prepared. And then the market rebounded, and we're back, and everyone's great. And rates are still high, and nothing bad has happened. So this is my open question, right? They raise rates. You think the world's going to implode? It's all bad. No, there are bad things, right? And we'll talk about this in a minute with the debt. But nothing bad has happened. So my open question is, how much do rates really impact the market nowadays? I mean, it used to. It was very directly correlated before. But is it really even correlated anymore? Because they went up and down, and yet it didn't impact the markets. Now they're talking about lowering rates, and the markets are fine. No one seems to care, is my point. And that's an open question for me. It should matter, but does it? I don't know.
Well, that reminds me, back, I don't know, 8 years ago, when I was teaching investing at Santa Clara University, one of my students asked me, what is the relationship between interest rates and the markets? And, I really wasn't sure. And of course, I felt like an idiot at the time. But I went back and researched that. And you're correct, Kirk. There are periods where low interest rates correlate with high stock prices. And then there are periods where there is very little correlation between interest rates and stock market prices. And I want to shift this a little back to what you said earlier, Kirk, because you're talking about what the market is doing based on the data that we have available and pricing in the current data into the market. And I want to ask you now, are you suggesting that investors be active in using this data to be an active investor and buy or sell based on what they think is going to happen in the future?
Yes and no. So what I'm suggesting is that any portfolio, whether unless you're putting 100% of your money in the S&P and you're just forgetting about it, which is not really a strategy, but I know some people do it. Unless you're doing that, yeah, but that's fine, right? If that's your strategy, right? You don't have to think about it. And I think for some people it's fine. But if you're actually doing any sort of management, like allocation, rebalancing, any of that, it does come into timing comes into play. If you're reallocating, timing will come into play. When are you doing it? Are you doing it at the pit of a bear market? Are you doing it at the peak of a bull market? Like, you don't know, but the point is you have transactions that are causing you to rebalance at a time that may or may not be good. And over time that may flatten out, but you're still doing it, right? But if you're just putting it all in and you're not selling, you're not rebalancing, it's simpler, right? So what I'm suggesting is that if you look back, and to your point, Barb, and I think from what I've researched, and I don't have great data on this because no one really thinks of it this way, but if you look at like the bear market periods, if you look at like the 70s, like 13 years in the 70s, if you look at the 13 years of 2000, 2013, if you look pretty much in the last few years, during those periods where it's quote unquote a bear market, even though it's sideways and going up and down a lot, what you'll see that the interest rates and the markets are not closely correlated. But if you look in bull markets, they are. And I don't, like I said, the data is not great, but that's the closest correlation I could see is in a rip roaring bull market, rates do matter. In a bear market or sideways market, it's just all over the place. And that's what I claim that this new paradigm is we're in a bear, I don't call it a bear market, but it's basically a kind of a haphazard market. It's a new paradigm. But when we go back to lower rates, I think we may be going back to the old paradigm of bull market all the way, where rates do start to matter again. So your timing question is that, am I asking about timing or not? I mean, I guess it doesn't matter till it does. If you're not into this and you're not following it, then you're not going to notice it and there's nothing you can do. But if you do follow it, rates do matter. Because what tends to happen, this gets into my earlier point of Wall Street prediction. How does Wall Street predict? When they start raising rates, they're going to keep raising rates until they stop. Right? That's the trend. They don't go up and down. They get a trend, they hit it, and then they stop it, and then they wait. And then now they're lowering rates, which means that they're not going up anymore because they don't want to do that. They don't want to throw people for a loop and go up and down. They want to keep the trend. Now, it may be a very slow trend or even flat, but it's not going to go up unless they start to see like really bad data, and they'll give people plenty of notice, which the Fed typically does. So the fact that it's trending down means that lower and lower and lower rates are in our future. It may take 5 years, but the future is trending lower for the foreseeable future unless something changes. So that's how I think about it, is that you should expect lower rates once they start lowering rates, because that's what Wall Street expects, and that's typically what the Fed does. So I don't know if that answers your question.
Yeah, I think it does. And although I raised my hand when you said, invest in the S&P and just stop, well, I'm a passive investor to a point. Because, yeah, I rebalance and I do watch the markets. And I think an action that people can take when we're talking about interest rates is bond values typically go up when interest rates go down. And so if you do have a bond portion in your portfolio, now might be the time to make sure that you're at the level that you have decided you want to be. In other words, you have the appropriate percentage of bonds within your portfolio. So, Phil, thoughts?
So my general view is I don't believe in trying to time, because when I try to time, I have to make more and more decisions, because I have to decide when to buy, I have to decide when to sell, and I have to do that multiple times. And the more times I have to make decisions, the greater the chance that I'm going to make the wrong decision. I start out with the idea that if we decided to invest, we're making an implicit assumption that the market's long-term direction is up. Because if I thought the market was going to go down over the long term, why would I ever put my money there? Because it's a losing proposition. So once I've made the commitment to invest, and the fact that the market's going to grow, I don't believe in trying to change my allocation substantially in reaction to the market. I will rebalance, and I use a tolerance band approach. What I mean by that is, let's say that you had a 60% stock and 40% bond allocation. If that got to 55-45 or 65-35, that's generally when I would try to rebalance. So I'm trying to let my process dictate when I make those decisions, because you mentioned recency bias. There's a whole host of other behavioral biases that can get in our way as investors. So by putting a process in place, I'm hoping to take some of that bias out, because the process tells me when to do it, instead of me trying to pick. In a lower rate environment, and if you remember when rates were zero, one of the reasons that people gave for the market doing so well, it was TINA, was the acronym, right? There is no alternative, because you had no place to put your cash. It was getting zero. Like, you'd look at your bank statement, and some of them still have this, right, where you're getting like 0.1%, some were even lower. Now there's some options to put your cash into places, even with rates coming down some, that are still giving you 4+% for a year. So there are some alternatives, but if rates start to fall too much, we get back into there is no alternative. And I can put my money into stocks that have better yields than I'm going to get from bonds. And those stocks have the potential for growth. They might not, but they have the potential for growth.
Yeah, no, I think it's good, and I think if you're still in the camp where your bank account's getting 10 basis points, I don't know what you're thinking. You're sleeping at the wheel. And we've talked about this in the show many times. When rates went up, bank accounts stayed the same because banks basically were underwater and they couldn't afford to pay more. So if you're in a bank that's paying 10 basis points, run, because it means it's a bad bank. The banks that give you higher rates means that they're well balanced and they can handle their balance sheet. So make sure you're at a bank that's giving you the kind of the equivalent of a 3-month treasury or somewhere thereabouts, because that's approximately where it should be if they want to be competitive. So I know some people are still getting 1 or under 1. You should choose a different bank. If nothing else, because you're going to get a better rate, but also because if they're really doing that, not only are they screwing you, but they might have a really poor balance sheet, and that might be a sign that the bank is in trouble anyway. So go ahead, Phil.
And I just want to add one anecdote to that. I'm not going to name the bank, even though I really want to. But there was, like, when I talk to people about putting the money in the bank, I tell them to go to sites like bankrate.com or nerdwallet.com so that they can go look for what banks are paying find an online bank that pays the highest rate. So I actually had this account. It was only because of an article in the Wall Street Journal, because I wasn't paying close attention. It didn't have a lot of money in it. It was in an account that used to be a high yield account. And then when interest rates started to change, they didn't change it. You had to have a new account with that bank to get the higher rate. So when I saw that, my reaction wasn't to say, oh, I'll just switch it to the other account. I took my money out of that bank because, as you said, I felt like they were screwing me.
Yeah, and some of them are, frankly. I'm not going to name the bank either. I know which one you're talking about, and they do have good credit card rates, so it's kind of, it's actually the lowest I've seen, and they have been consistently. So it's like, all right, at least I'm using them for debt. So if they go under, I'm like, all right, lose my debt, whatever. That's on you. Not putting my assets there, that's for sure. Anyway, Barb, what's next on the list? We got a whole bunch of stuff. Elections, AI. We got a lot of stuff going on in the news.
Not elections. Okay.
Really?
We
Oh,
are not talking about elections.
we talk about that all the time on
We,
the show. Come on,
we
you're
are
ruining it.
talking about AI, okay? Because AI is everywhere. And actually, I've been watching Star Trek Discovery. It's an older show, but I got to tell you, I don't know. Have you guys ever watched that show?
Nothing, as long if it doesn't have William Shatner, I'm not watching it. That's all I can say.
Unfortunately, it does not have William
Chris Pine's
Shatner.
good though in the new movies. Chris Pine did a good job.
Yeah, well, it doesn't have Chris Pine.
Okay, well, I don't know. I'm not interested.
But anyhow, it is amazing. But let me tell you, in that show, AI is very, very bad.
Okay.
But dare I digress? The main news about AI is if you don't know what GPT is, well, shame on you. But Apple and NVIDIA are in talks now to take positions in OpenAI, which is the company that has ChatGPT. So obviously, AI is here to stay. I hope it will not be as bad as it is in Star Trek Discovery, because that's very scary.
Or Terminator. Just saying. Just saying.
But yes, what I wanted to talk about is I know both of you routinely use AI in your work. And I just want the listeners to know, how do you use it? How does it work? Pros, cons, and what kind of advice do you have for those of us out there who are not using it a lot? Because in all my attempts to use it, like I'm a professional writer and I've used it sometimes to do research. And I got to say, the results have been pretty crap. So I'd like to hear from you two. How does it work for you?
You're up, Phil.
So I use it in a lot of different ways. One way that is my favorite is my practice is largely virtual. So I meet most of my clients on Zoom. When I meet with my clients on Zoom, I use an AI tool to record the call. What that does for me is when I'm meeting with my client or prospect, I can talk to them. I don't have to write a lot down because I know that they're recording the call, that the AI tool is recording the call. That means I can be a better listener. The tool that I use actually tells me how much time during the call I'm talking. And there's certain meetings where I really want the client to talk way more than I do. Like my goal is to not talk more than 20% of the call, and that includes when I'm asking questions. And I can use this tool. It tells me how much of the time I spent talking. So I know that when the call is over, it generates a summary. I can take that summary. What I do with that summary is I take it and I copy and paste it and put it into my CRM, which is my client database. I make any necessary edits to the summary. And then that gets saved as my client note from the call. The tool also has a link to where that was discussed in the call if I needed more specifics. The whole call is recorded. And I have reached out to the company to ask them, like, what are they doing to protect this so that because I don't want, look, there's a lot of personal information that can be exchanged, and I'm comfortable that the way that they're storing the data is that as a client, you're safe. I've had clients that have asked for their copies because I can share it with them. And from a note-taking perspective and keeping track of your conversations, it's an immeasurable time saver, because it used to be I had to write stuff down. If you're writing a lot of things down when you're talking to somebody, you don't hear everything they say because you're writing, you can't hear all the words, right? So I know I get a better represent. And then since I listened, I can fill in any of the holes in that summary because it's all in my head because I was listening to them. And it used to take, I'd write it down and then it'd have to be typed and put into the CRM, or sometimes it just made it into a file cabinet because I didn't have the time to type it. So it saves me a lot of time to do that. Other ways that I use AI, I don't have the free version any longer. I paid for the one that you pay like $20 a month. And so now I have the more current version of ChatGPT because the original one has some old data, didn't get updated. So I did pay for it. I will use it, say, here's who I work with. Can you suggest some articles that might be of interest to them? And it will give me back responses and tell me what might be of interest to my niche market, which is women facing new beginnings. So it can help me get ideas. It can outline an article for you if you want. You can even, I was talking with my business coach about this, you can even teach AI. Like I can share blogs that I've written and other information so that it understands my writing style. And I could ask it to write on a topic that I would then, of course, still edit anyway. But it would start by writing it more in the style that I use. And I played around with it. And like when I looked at how it described my style, I said, yeah, that is what I'm trying to accomplish when I write. So I think it did a pretty good job of understanding. So I use it for things like that and just for some general research.
You know, Phil, before we turn it over to Kirk, I have a follow-up question. Now, I've used the free Chat GBT and I've been extremely disappointed. I've also used Gemini. I've also used the Microsoft version. None of them, when it comes to researching information for my articles, it's all been super general. Do you see a big difference between the free and the paid version of OpenAI?
I think the paid version is a little bit better. And also, I'll tell you that if I feel like it's general, I will go back to and say, hey, we talked about this. Could you expand on that more? Right. So
See,
try to
I've
use,
done that and I still have not gotten the depth that I
okay.
want. And so I'm like not I'm frustrated because people are like you are talking about, oh, I get these great outlines and blah blah blah. And I'm like, how?
Yeah. I mean, I'm
And of
even,
course I'm not paying for anything. So maybe that's it.
it does feel better since I started to pay for it. I'm also using it the other way is I'm doing a book club. We're taking the book, The Psychology of Money by Morgan Housel. I'm doing it over 4 sessions. I did the first one this past week. And I helped it to give me some ideas as to a general outline of what the 4 sessions would be, as well as some of the materials that I sent out to try to market for it. And it can do that and say, here, this generate a sample email, a sample LinkedIn post, a sample Facebook post, which again, like I said, you have to go edit because you can't just take what it says. But it's a big time saver to have it give you that head start.
Yeah, so in my experience, so when it came out, I did a deep dive in this. We actually did one of our sessions here. We really dug deep into AI, how it works, because I'm a big fan of like deep water testing stuff. So I'm in there pushing the envelope with AI. I'm asking it questions. I'm trying to, this before people thought I was hallucinating. I was basically gaslighting it. And what I was trying to do was figure out where are the boundaries, right? I'm always interested in pushing the boundaries because you got to figure out where it can go. And so I did a bunch of stuff with it back then. So I have that as a data point. And I actually back then I had it write a legitimate like SEO friendly blog post on inflation. It did a really good job as a textbook. So it literally took me 5 minutes. So it was what are the best inflation related keywords in SEO. The next step was write me an outline for this keyword. Next step was based on this outline, write me 1,000 word blog post. It only went up to 600 words, but I told to break it up. So write me the blog post, and I read it, and it was functionally solid if I was reading a textbook. The problem was there was no emotion. There was no stories. It was dry. And frankly, if you're writing about inflation, inflation is all of those things. But if you're talking about a story like, how to save for retirement, people like to read stories. And it would have been a very boring article. So I realized that. I also tested it out early on with jokes. Because the thing about jokes is they're a very human thing in that it requires you to understand people. It requires you to understand the language. It requires you to understand culture. And so I asked it, tell me a joke, tell me riddles. It was very bad at riddles. What it would do is it would take riddles it found on the internet, and then I would say, tell me another one, tell me another. So I kept asking for more and more. And at some point, it started to repeat the old ones, but it never made up its own. Same thing with jokes. It did the same thing. It just took other ones and then started repeating them, or the jokes were terrible. It really didn't understand people. Now, I haven't done that again with the new version, but I've heard it's gotten a little bit better. Not quite to the extent where you can tell it's a human or not, like the Turing test with jokes, because I think jokes if it can tell a really good joke, that's the ultimate Turing test, because that means it truly understands people and understands the language, and it can create things that aren't already existing. So for me, that's the ultimate Turing test. Now, when it comes to functionality for work, there's two parts to this. So our industry is grappling with this. So the SEC is not all on the same page with how this should or should not be applied. And I've spoken to some people in the SEC in the last, I don't know, year about this, and they're a little hesitant to say, yes, you can do this and all this, because there's a lot of questions, right? And I think they're taking the right stance on this because it's new. As Phil said, you've got to protect your data. How do I know what OpenAI is going to do with my data, right? If you put it in there, what are they going to do with it? It's not protected. It's not a walled garden. It's basically just in their database, and then they use it for other people. Now, they might not explicitly use a person's data and say, "Oh, this is this person's data," because I think it's very clearly has some rules in there which doesn't allow you to focus on certain people. Although sometimes that happens, sometimes it doesn't. But generally speaking, there are some parameters in there that's protective. But I certainly don't want my client data going into the Ethernet of not the Ethernet, but the OpenAI version of of the internet. And so I think there's a lot of questions there still when it comes to privacy. And so I look at the AI kind of trend as there's general AI, and I'm not talking about AGI. I'm just saying like the general AI that we all use. But I think one of the trends is going to be that people are going to have their own AI version. We'll have our own walled garden, if you will. Will you train it? It gets to know you. It knows your language. It knows you. Like that, I think, is the decentralized version of the. So if you look at trends, like we were centralized from like 2000 till somewhat recently. The trend was centralize everything. Everything's on Facebook. Go to Facebook. Everything's on Google. Go to Google. Everything's on these platforms. Go to these platforms. That's the old way. Now things are starting to decentralize. Crypto and blockchain make this possible. But now people are going to start to have their own identity online, right? So the future of this is going to be I'm not giving Facebook my data. I own my data. And if I choose to sell it to Facebook, then I can get paid for that. And that's on me. When you centralize it, when you own your own online identity, you can do that. And I think that's going to be the future trend of this. I like that direction because then people have the choice about whether they decide to give up their data. It's like healthcare, right? I want my health information private. I don't want to give it to people. But if I, let's say I was economically challenged, I didn't have a lot of money, and I decided, well, I can get free healthcare, really cheap healthcare by giving away my health data to everybody, and they could use it however they want. Well, that's a choice. And I think that's a reasonable choice to make for an individual consumer, right? But currently with the centralization, we don't have that choice. But with the decentralized trend, we will have that choice, and a lot more things are going to be feasible as an economy, right? People won't be taking advantage of you. You'll be able to take advantage of yourself. And that's your choice. So I think when it comes to AI, the future is going to be you're going to have your own personal AI, and that is going to learn what you like and don't like. It's going to learn your language. It's going to learn your mannerisms, all of your nuances that you have, and it's going to be able to recreate stuff for you. So I'm not using it to write because I haven't found it to be good enough. And frankly, if it writes something, now I've got to edit the whole thing. And I hate editing. I mean, Barb, I know you're a writer. Editing is my nemesis. Like I want to write it once and I'm done. I check for spelling and that's it. That's it. Like I don't do it twice. Like once is enough. Once is too much. So the way I'm kind of using it now is I'm using it for little tasks. So for instance, I was looking to find what are all the companies that are, or I was looking at like IMOs or FMOs, which is kind of like a insurance industry sort of company. You can't find a list online. And I was doing this research for a friend of mine. So I looked it up. I said, AI, what's the list of all the IMOs or FMOs? And it gave me a huge list. I was like, you couldn't find this online. It doesn't exist. Like, it's weird, but it doesn't. So it gave me this huge list. I'm like, wow, I did this. It took me 1 minute. I can give this to my friend. It would have taken him a week to compile all this. It took me a minute. So if I think about, I've I've been slow to adopt it because I think when you have your habits, when you have your patterns, when you have your processes, it's really hard to go through and say, all right, which is this? Is this good for this? Is this good for this? So I've started to do is slowly adopt it. Like for example, I went to I heard the story that some people were using AI to diagnose medical conditions. I was like, that's really interesting. So I tried it. I've got some issues. My son has some issues. And I was like, let's try this. Let's just try it out. And so I put in some testing data. Like, here's the blood test. Here are the results. What is a possible conclusion? And you have to prompt it. It was just like, let's assume I'm a medical student and I'm trying to diagnose this patient. Given this data, what would you conclude? It was spot on. I mean, it was it was amazingly good. And I was using the free version. I don't have the paid version like Phil, but I think the free version, you can use it a limited number of times a day. It's similar to the paid, but you only have a limited use, like 10 times or something, and then you have to wait 24 hours. Um, but but I used it and I was like, okay, that's wrong. What if you include this? Oh, okay, and it gives me another diagnosis. And after I updated it, I was like, holy crap, this is like, it doesn't know anything about the person. It's just looking at the data, and it was really, really good. I asked it to give me because sometimes these things, like there's no definitiveness. So I was like, give me the probability of accuracy, and it was just like moderate, high, low. It was really good. I was shocked. So when you look at something like that, the application of that, it leads me to believe that we're not going to have any doctors at some point, because doctors are basically pharmacists nowadays. There are good doctors, but a lot of them are just paid pharmacists. But if you look at the medical profession, right, it's going to change, right? If you look at the people who are doing the significant surgeries, right, that's probably going to help them, but they're still going to do it. But if you got the everyday diagnosis, I've got this pain here, I've got this thing here, I think AI is going to probably do a much better job, and you don't need to pay a doctor to tell you, take 2 of these and call me in the morning. So I don't 100% see the application for our industry completely, because from marketing standpoint, there are some benefits which I am exploring. The hard part about the marketing is that it requires you to have your own walled garden, which I think Google Notebook is LLM Notebook is, I think, was what it's called, where you can dump data in and you can create your own version. I'm not an expert in this yet. I'm playing around with it, but I do believe that you can create your own personal AI this way. So I was thinking about some ways to apply this, and one of my thoughts was take all the best copywriters out there, best marketing copywriters, and take all their stuff and dump it into this pool and say, spit me out a sales letter based on all these people in the voice of X. And my understanding is it's going to do it. It could probably do it now without me doing that. But my thing is, how do you create opportunities that people aren't seeing at the moment to really refine what you're already doing, instead of saying, I'm just going to have it right for me, which is lazy, and I think it'll come out with a bad product. So that's the balance that I have, is between the privacy, the regulators, and how can I find areas which are not regulatory, which are not privacy related, but make my life easier and save me a ton of time. So that's how I'm looking at it at the moment. I do think that things are working both faster and slower than we all see. I think one day people are going to wake up and be like, holy crap, my job is toast because I was sleeping. And I also think it's going to also happen slower than some people think too, because people aren't applying it. The CEOs don't see the benefit. They're not making a profit on it. It's costing a lot of money. So a lot of them are just saying, I'll come back to it. Much like the internet. The internet, people got on it and then they didn't see it, and eventually it figured itself out over time. I think AI is going to take the same trend. So it's going to be a rocket shot to the moon, then it's going to fall. Everyone's going to say, oh, it's done, it's all over. Probably the AI stocks are going to fall through the floor, and then it's going to recreate itself, and it's going to be the next great thing. I think that's much like every other trend that's happened prior to this. I think it's going to happen in a similar way. All right. We should probably wrap it up because I know people have better things to do than listen to us on a Labor Day pre-weekend. So, Phil, final thoughts from you.
Thanks for having me today. This was a great conversation. Some of those things you just talked about with AI, you can do more easily in the paid version. Like you can set up and create your own GPTs and things like that, which is what you're trying. You can feed it links to content and it will take that content and analyze it for you. That's how you create the voice that you're looking for. As for me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you could download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our weekly blog. Thanks for having me, and hope everybody has a great Labor Day weekend.
Great. Thanks for coming on, Phil. And Barb, final thoughts from you.
I just want everyone to benefit from my decades of investment experience and my mistakes. So you can find out more about me at my YouTube channel, Barbara Friedberg, and on my website, Barbara Friedberg, personalfinance.com. You can contact me there. Thanks so much for having me on today. Bye.
Yeah, thanks for coming on, Barb. And by the way, you're not going to find Barb's mistakes there because she doesn't make any. So just for reference, if you're looking for those, you're not going to find it. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.